Okay, so in this video, still lesson 1, external financial reporting, section 4, I'm going to talk about the statement of changes in equity. So again, just a recap, for the full set of financial statements, we have 5. First, statement of financial position or balance sheet. Second, statement of profit or loss and other comprehensive income or income statement. Third, we have statement of changes in equity. Fourth, we have statement of cash flows. And fifth, we have the notes to financial statements. So for the outline, first, I'm going to talk about the statement of changes in equity. Second, the statement of retained earnings. Third, the common features of the common and preferred shares. Fourth, what are the equity transactions? And fifth, the note disclosure specifically pertaining to the statement of changes in equity. And lastly, the limitations of the statement of changes in equity. So first, statement of changes in equity basically is just a reconciliation for the accounting period of the beginning and ending balances in a company's equity during the reporting period. So we have here the equation for the equity. First, we have the beginning equity, meaning the equity in prior period. Then we add the net income or loss during the period. Then we deduct the dividends distributed during the period. So actually, the dividends is subtracted from the retained earnings. Then we add or deduct the other changes. And then we get the ending equity. So here is a detailed picture of the components of equity. So as discussed earlier, we have the beginning equity. Then we add the net income or loss for the period. We deduct the dividends paid. Actually, we deduct the dividends declared. So this should be dividends declared. So for the other changes, these are equity transactions. So for instance, we have issuance of common shares, change in other comprehensive income, acquisition of treasury shares, and so on. So what is a statement of retained earnings? So basically, it's just a reconciliation of the beginning and ending balances of the account or the retained earnings. So the retained earnings is reported as part of the statement of changes in equity. We have here the equation of the retained earnings. First, we have the retained earnings beginning balance or the retained earnings in prior period. Then we add the net income or loss during the period. We deduct the dividends declared during the period, so it should be dividends declared. Then we add or deduct the prior period adjustments. Then we also add and deduct any change in accounting estimates. After that, we arrive at the retained earnings ending balance. So you might wonder what are prior period adjustments and change in accounting estimates. So this might sound unusual. So when we say prior period adjustments, so basically these are just correction of an accounting error that occurred in the past and was also reported in the prior year's financial statements. So in other words, the prior year adjustments, these refers to the correction of any accounting errors we made in prior year. And because of that, since this is originating in prior year, it requires retrospective application. So when we say retrospective application, this means that we need to change the carrying balance of the retained earnings, or in other words, the opening balance or the carrying balance of the retained earnings, and adjust it as if the accounting was done properly in the past periods. So meaning we effect the correcting entry by adjusting the opening or the beginning retained earnings balance. So what's the purpose of prior period adjustment? So basically the main purpose is just to fix the mathematical errors, any improper accounting methods, and overlooked facts in the past periods. In addition, it includes a cumulative effect on the income statement of 1. We have changes in accounting principle. Second, the corrections of prior period financial statement errors. So when we say change in accounting principle, so for example, an entity is permitted to change an accounting policy if the change is only first required by a standard or interpretation. An entity is also permitted if the results in the financial statements providing reliable and more relevant information about the effects of transactions, other events or conditions on the entity's financial position, financial performance, or cash flows. So also note that change in accounting policies or change in accounting principle do not include applying an accounting policy to a kind of transaction or event that did not occur previously or were immaterial. Also, when we say retrospective applications, it means that we are adjusting the opening balance of each affected component of equity for the earliest prior period presented and other comparative amounts disclosed for each prior period presented, it's as if the new accounting policy had always been applied. Now, when we say correction of prior period financial statement errors, this simply means correction of prior period errors and any cumulative effect of changes in the accounting principle. For correction of prior period financial statement errors, note that the correction of prior period errors and any cumulative effect of the changes in accounting principle must not be included in the calculation of the current period net income. So in other words, it should not affect the current period net income. Now, what do we mean by change in accounting estimate? So basically, a change in accounting estimate is simply an adjustment of the carrying amount of an asset or liability or related expenses relating from reassessing the expected future benefits and obligations associated with the asset or liability. So meaning, some counts in the balance sheet, for example, some assets or liabilities are based on estimates, and yearly or an annual basis, we conduct a reassessment of these estimates. Now, if there is a material change in the accounting estimates, this should be accounted for as change in accounting estimates. Hence, these require prospective application, meaning any effect of a change in accounting estimate shall be recognized prospectively by including it in the profit or loss. Take note, during the period of the change, if the change affects the period only, or the period of the change and the future periods if the change affects both. Meaning, if there is a change in accounting estimates, any effect should be applied during the current period and the future period. So meaning the effect should not impact the prior period net income. However, please take note that a change in accounting estimates give rise to changes in assets and liabilities, or it relates to an item of equity, then it is recognized by adjusting the carrying amount of the related asset, liability, or equity item in the period of the change. So here are some examples of the change in accounting estimates. So for example, we have here allowance for doubtful accounts. This is a contra asset account, a contra account of the accounts receivables. Second, allowance for inventory write-down. So this is also a contra account of the inventory balance. Third, we have change in useful life of depreciable assets. So this impacts the fixed assets. Fourth, we have changes in salvage value of depreciable assets. So this also impacts the fixed assets. Fifth, changes in the amount of expected warranty obligations. So now let's talk about the common features of the common and preferred shares. So take note, shares can be common or preferred. So we have here common terms which you should also be familiarized. So first, we have stock authorized. When we say stock authorized, this simply means the maximum amount of stock that a corporation is legally allowed to issue. So in every corporation, there is only a maximum amount of a stock that they can issue. So it's not allowed to exceed. Second, stock issued. So when we say stock issued, these pertains to the amount of stock authorized that has actually been issued by the corporation. So, for example, a company can have 1 million stock authorized. However, only 500,000 shares has been issued. Third, stock outstanding. So, these pertains to the amount of stock issued that has been purchased and is held by the shareholders. So, you might be confused about the difference between stock issued and stock outstanding. So actually, stock issued includes all stocks or shares which have been previously issued by the corporation. So sometimes, a corporation may actually reacquire the previously issued shares. So in that case, that becomes treasury shares. So if that is the case, all shares which have been issued and reacquired by a corporation should no longer form part of the stock or shares outstanding. In other words, shares outstanding or stock outstanding only includes those shares which are currently held by shareholders. Now, let's talk about the difference between common shares and preferred shares. So here I have summarized in table format the main difference between the two. So first, let's talk about the voting rights. So common stockholders have voting rights while preferred stockholders don't have voting rights. Second, priority over dividends. Now, common stockholders have lower priority as compared to the preferred stockholders. In terms of right to the liquidating assets, similarly, common stockholders have lower priority as opposed to the preferred stockholders. So let's discuss further the main features of the common shares. Basically, common shares pertain to the shares of ownership in a company. So if you are a holder of shares of a company, then you have ownership in that particular company and you are called a shareholder. So what do you mean by common shareholders? Here are the characteristics. First, they have voting rights. Second, they have preemptive rights. Third, they select the firm's board of directors and vote on resolutions. Fourth, they are not entitled to dividends unless declared by the board of directors. And fifth, they are entitled to liquidating dividends after all claims are satisfied in distributions to the preferred shareholders. So, first item here, of course, as I mentioned earlier, common shareholders have voting rights as opposed to the preferred shareholders. Second, they have preemptive rights. So what do you mean by preemptive rights? So it means that common shareholders have the right to purchase any additional stock issuances in proportion to their ownership percentages. So the main goal here is to preserve their ownership percentages in case there are any stock issuances. So third feature, they can select a board of directors and vote on resolutions. Fourth, they are not entitled to dividends unless declared. Fifth, they are entitled to liquidating dividends but only after distributions to preferred shareholders. Meaning, the common shareholders are the last in line when it comes to companies' assets, which means that they will be paid only after creditors, bondholders, and preferred shareholders. Now, what do we mean by preferred shares? So these represent ownership in a corporation. However, the difference is that preferred shares have a priority claim over common shareholders. So here are the common features. First, in case if it's a cumulative preferred stock, any unpaid dividends is accumulated, which is also termed as the dividends in arrears. It simply means that dividends in arrears must be paid before any common dividends can be paid. So for example, this year the company has declared dividends to preferred shares. However, there is no distribution. So in the next year, before the common shareholders receive their dividend payment, the dividend of the preferred shareholders in last year will have to be satisfied first before common shareholders are entitled to dividend payment. Second, we also have this feature, which is the convertible preferred stock. This simply means that the preferred shareholders has the right to convert the stock into shares of another class. And this is usually at a predetermined ratio. So for example, preferred shareholders may have the right to choose or to decide whether they want to convert their preferred stock, for example, into bonds or also into common shares. So as a continuation, preferred shareholders has features of debt and equity. However, in terms of classification, the preferred shares are classified as an equity or it is presented in the balance sheet under the equity section. So it is presented in equity section. Also, the preferred shareholders, it has a fixed charge. However, payment of dividends is not an obligation. So preferred shareholders has the right to receive first, dividends at a specified fixed rate before common shareholders may receive. Second, distributions before common shareholders but after creditors in the event of the firm bankruptcy. So actually, during the liquidation process or in the event of bankruptcy, there's actually a hierarchy as to who will first receive the liquidating assets of the liquidating company. So the hierarchy there is, of course, so first, creditors are superior, of course, then preferred shareholders, and then lastly is the common shareholders. Now let's talk about the common equity transactions. So first, we have here issuance of shares. Second, dividends or dividend declaration or dividend payment. So for dividends, we have three. First, we have cash dividends. Second, we have property dividends. Third, we have stock dividends. And another equity transaction or share split. And fourth is the repurchase of shares or treasury shares. So if you can remember a while ago, I've mentioned that any shares which have been previously issued but reacquired by a company should no longer form part of the outstanding share. So those shares which have been reacquired, these shares are called treasury shares. So first, let's talk about issuance of shares. So here is the usual journal entry. Upon issuance of shares, we debit cash by the amount received by the company for the issuance of shares. And take note, in the credit side, we have two. So we have share capital and share premium. So the amount of share capital is equal to the par value of the shares issued multiplied by the number of shares. Any difference between the par value of the shares issued and the cash received, this should go to the share premium. So sometimes a company also incur direct costs of issuing stock, and this direct cost, take note, must not be recognized as an expense. So what are these direct costs? First, we have underwriting costs. Second, legal fees. Third, accounting fees. Fourth, tax and registration fees. Now let's talk about the dividends. So first, let's be familiarized with the three terms. We have the three dates here. First, the date of declaration. So this simply means the date when the board of directors formally approves a dividend. Second, we have the date of record, meaning it is a date when all holders of the stock are legally entitled to receive a dividend. Third, we have the date of payment. It is the date in which the dividend is paid. So again, as mentioned earlier, we have several types of dividends: cash dividend, property dividend, and stock dividend. So for the cash dividend, this simply means the cash distributions of the accumulated earnings by a corporation to its stockholders. So these simply means the cash distributions of accumulated earnings by a corporation to its stockholders. So let's have an example for the cash dividend. So here is a sample problem. So let me read. So on January 21, a corporation's board of directors declared a 2% cash dividend on 100,000 of outstanding common stock. The dividend will be paid on March 1 to stockholders of record on February 5. Now, in terms of identifying the three dates here, we have January 21, which is the date of declaration. March 1 is the date of payment. And February 5 is the date of record. Now, the 100,000 US dollars pertain to the outstanding common stock, and 2% of which is 2,000. Now, what are the entries? On the date of declaration, or January 21, we simply debit retained earnings and credit dividend payables by 2,000, which is 2% of 100,000 US dollars. So on the date of record, which is February 5, we don't do anything. Okay, there's no actually entry for that. There's only an entry upon dividend payment, that is on March 1. The entry will now be a debit to dividends payable and a credit to cash amounting to 2,000 US dollars. So okay, hopefully it's clear. So second, let's talk about property dividend. So property dividend is simply a distribution of property, both physical or financial, in lieu of cash or cash equivalents. So examples, we have distribution of shares of a subsidiary, or property dividend can also be in the form of physical assets such as inventories, equipment, and real estate. So moreover, when an entity declares a dividend consisting of tangible property, take note of this: the property is remeasured to fair value as of the date of declaration, and then the carrying amount of retained earnings is decreased for the fair value of the property to be distributed. Lastly, property is distributed as a dividend. So take note of these three, okay? So first, we need to remeasure on the date of the declaration the value of the property on the books of the company to its fair value. After that, upon distribution, we debit retained earnings equivalent to the fair value of the property on the date of the distribution. So let's have an example here, okay? So the problem says on January 1, ABC Company's board of directors declared a property dividend. The company originally acquired the property for 500,000 US dollars, and the property of a fair value amounting to 2 million US dollars as of the date of the dividend declaration. The dividend will be paid on March 1 to stockholders of record on February 5. If we take a look at the important things in the problem, we should look at these things. So first, the date of dividend declaration is January 1. The date of payment is March 1. The date of record is February 5. And take note of the amounts. The original acquisition cost of the property is $500,000 US dollars, and the fair value as of the dividend declaration date is $2 million. So for the journal entries on the date of declaration, as mentioned earlier, so we need to remeasure the fair value of the property to be distributed in the books of the company. So here, since the original cost of the property on the books of the company is just $500,000, we first remeasure it to its fair value, and hence we debit property and we credit gain and appreciation equivalent to the difference between the fair value and the original cost, and that is $1,500,000 US dollars. Similarly, in January 1, we debit retained earnings by $2 million, which is the remeasured value of the property, and we credit dividends payable by $2 million. On the date of payment, in this case, we are assuming that the fair value of the property is the same during the date of declaration. Hence here, if you can see, we debit dividends payable and credit property equal to $2 million, or the fair value. Now, in case on the date of payment, the fair value of the property is higher, for instance, $2,500,000, we first remeasure the property on the date of payment. So we increase property by $500,000 again, gain and appreciation by $500,000, and then in the next entry, upon dividend payment or dividend distribution or property distribution, we debit dividends payable equivalent to $2,500,000 and credit property by $2,500,000. Now that is if the case is the fair value of the property is different during the date of declaration and date of property distribution. Third, let's talk about stock dividends. So, stock dividends, it involves no distribution of cash or other property. So, stock dividends are accounted for as a reclassification of different equity accounts, not as liabilities. So, stock dividends can be issuance of shares. First, it can be less than 20% to 25% of the previously outstanding common shares. Now, if this is the case, this is called a small stock dividend, and on recording the entry, fair value is used. On the other hand, if the issuance of shares is more than 20% to 25% of the previously outstanding common shares, this is called large stock dividend, and hence the par value is used. In addition, for small stock dividend or stock dividend wherein it's less than 20% to 25%, take note that the fair value of the additional shares issued is simply reclassified from retained earnings to common shares at par value. So take note at par value, and any difference is equal to share premium. So again, let me repeat this. If it's a small stock dividend, the total amount to be debited to retained earnings is equal to fair value. Now, we said that it's simply a reclassification of equity account, right? So, the common shares that we need to credit is only equal to par value, and since there's a difference between the par value and fair value, any difference shall be credited to share premium. So, we have here an example, okay? So, common shares is equal to 600,000. It's composed of 30,000 shares issued and outstanding, which is 20 par value. We have additional paid-in capital of 300,000 and retained earnings 600,000. Hence, the total shareholders' equity is 1,500,000. Hence, the total stockholders' equity is 1,500,000. So let me read the problem. The firm issued a 20% stock dividend on a date where the stock was selling at 25 per share and par value of 20 per share. The fair value of the 6,000 shares is 150,000. If you can see here, it's a 20% stock dividend, hence this will qualify under small stock dividend. And it's also given the problem that the fair value per share is 25, which is different from the par value of 20. So since this is small stock dividend, in the amount to be debited under the retained earnings, we are going to use the fair value. On the date of declaration, the entry is debit retained earnings by 150,000, which is equal to the fair value of the 6,000 shares, or also computed as 6,000 multiplied by 25. And then we credit common shares distributable and then share premium. Now, for the common shares distributable, if you can see here, it's only 120,000, which is equal to 6,000 shares multiplied by 20 US dollars, which is the par value of the common shares. As I mentioned earlier, any difference between the fair value and the par value should be credited to share premium. In this case, the difference is 30,000 US dollars. On the date of the issuance, we debit common shares distributable and we credit common shares by the amount of par value. Now, for the share premium, you don't have to do anything about it. Now, on the other hand, large stock dividend or stock dividend, which is more than 20% to 25% of the shares outstanding, the par value of the additional shares issued is classified from retained earnings to common shares. So as opposed to the small stock dividend, here we debit retained earnings equal to the par value only. So let's have an example here. So we have the same given. It's still 30,000 shares issued and outstanding at 20 par value or common shares of 600,000 US dollars. And we have additional paid in capital of 300,000 US dollars. We have retained earnings of 600,000 US dollars. And we have total stockholders' equity of 1,500,000 US dollars. Now the problem says it's the same. The firm issued 50% stock dividend. So as opposed to the problem a while ago. So here, if you note, the problem is already 50% stock dividend as opposed to the other problem, which is 20% stock problem. So let me read the problem. The firm issued 50% stock dividend on a date where the stock was selling at 25 per share in par value of 20 per share. The fair value of the 6,000 shares is 150,000 US dollars. Now, this is actually the same problem, only that here it's already 50% stock dividend. Hence, this qualifies under the large stock dividend. So, on the date of declaration, the entry here is debit retained earnings credit common shares distributable. So, the entry here is on the date of declaration, we debit retained earnings, we credit common shares distributable for 300,000 US dollars, which is computed 600,000 multiplied by 50%, or another way to compute this is 50% of 30,000 shares outstanding is 15,000 stocks. You multiply this by 20 par value, we get 300,000 US dollars. So here, you just have to ignore the fair value of the 6,000 because obviously the 50% of 30,000 shares issued and outstanding is not 6,000 but 15,000. On the date of issuance, we debit common shares distributable by 300,000 US dollars and we credit common shares by 300,000 US dollars. Third, equity transaction, stock split. So this refers to the issuances of shares that do not affect any aggregate par value of shares issued and outstanding or total equity. So basically, stock split can be, for example, if the company has 100,000 common shares issued and outstanding, the company declare 2:1. So basically, the previously issued and outstanding common shares of 100,000 will now become 200,000. So stock split reduces the par value of each stock and increases the number of shares outstanding, and vice versa. So repurchase of shares or treasury shares, as mentioned earlier, this refers to formerly outstanding shares that have been repurchased and is held by the issuing company. So shares which have been issued but reacquired are no longer part of the outstanding shares. As such, the result is that the total number of shares in the open market decreases. Also, these shares are issued but no longer outstanding, and therefore these shares are not included in the distribution of dividends or the calculations of the earnings per share. So what are the major statement of changes in equity note disclosures? So we have here the note disclosures and schedules, which specifically relate to the statement of changes in equity. First, we have the class of stock. So it includes related rights and privileges, share-based payment compensation, dividend declaration, retained earnings, and stockholders' equity. Lastly, let's talk about the limitations of the statement of changes in equity. So just like the other financial statements, the statement of changes in equity report an accrual basis results for the period. And similar as well, second, the statement of changes in equity illustrates a company's equity based on a specific time period. So I hope this has been helpful to you. Comment below if you have further questions and clarifications. And rest assured, I'm going to complete the syllabus. My name is Jean. Thank you for watching. If you like this video, hit like, share, and subscribe. Till next time.